FinTech. Hello, everyone. I'm Jason. I'm the finance economics editor at Quartz, global business news site. Hopefully, you've all heard of it and read about it. So we're going to have a bit of a different format for this one. I have three esteemed speakers with me who will give short presentations, and then we're going to all sit down for a discussion. So FinTech, we're in one of, if not the center of the FinTech world here in London, so it's very appropriate. Broadly speaking, FinTech means different things to different people. It's not solely the domain of startups or of big established financial firms, and that really plays nicely to the theme of this whole conference, which is about collaboration between the big brands and startups and that kind of thing. And that's definitely what's happening in FinTech, and our panel reflects that. We have Oliver Harris from JPMorgan, Andrew Ellis from RBS, and Boden from Starling Bank, which is one of these challenger banks that we're all reading about. I was looking at the latest stats of the global FinTech industry, and what was particularly interesting to me is that corporate venture arms are now worth about 20% of investment in FinTech, which is roughly double from what it was just 3 or 4 years ago. And I think that kind of reflects the maturity of the sector and what's happening there. And we're going to talk a lot about collaboration, co-creation, acquisition, partnership, competition, co-opetition, whatever, all these various buzzwords of how startups and big companies work together in FinTech. And I'm going to take a seat over here, and we're going to hear from each of our panelists in turn, and then they'll all come up together and we'll chat. So first, Ollie Harris, who's the FinTech and in-residence lead at JPMorgan, is going to talk a bit about that collaboration and co-creation that he is doing at big established company. Ollie.
Thanks, Jason. Yeah, great to be here, and I've been given clear instructions to stay on the carpet, so apologies if I look a bit like forced in my nature. Going to talk about 3 things very quickly. 1, why now? Why does this actually matter? 2, how are large incumbents such as JPMorgan dealing with FinTech and innovation? And then 3, I'm going to spend most of my talk using in-residence as a case study through essentially our unique way of collaborating with startups. So 1, why now? Why does this actually matter? I think especially from a wholesale banking and capital markets perspective, FinTech is actually nothing new. We've always invested in technology. From our perspective, both the product, what we're delivering to clients, and technology has always been intrinsically linked. However, there are 3 key emerging trends which are actually driving this potential disruption and this wave of innovation we're seeing across financial services. 1, obviously, is the new technologies. Emerging technologies such as blockchain, artificial intelligence, robotic process automation, and some of the topics that we'll delve into a bit more detail later on with the panel discussion. 2, regulatory change, whether it's MiFID II on the capital markets perspective, PSD2, the list goes on. I think that's driving a lot of market structure change within the industry. And then 3rd, actually, our employees, our clients, emerging cultural trends and preferences. The classic example of it, using our mobile phones, changing preferences, and that's why something that I think is missed is actually design and the importance of design in creating products for clients. So if that's the why now and the trends creating this wave of innovation, what can large corporates like JPMorgan do about this? And I think the key thing is you have to take a portfolio approach to innovation, which means 1, actually building in-house capabilities within the firm to learn about these new technologies, emerging trends, and actually create the right talent and skills within the firm. And we're doing a lot there in terms of dedicated centers of excellence for blockchain, AI, etc. The second, is actually a structured way to engage with the ecosystem, whether it's accelerators, incubators, universities, the list goes on. We have to do this in a very structured manner. And then the last, which I'll spend some time on, is that space between large corporates and early stage companies. How do you actually generate value that's mutually beneficial both for large corporates and early stage startups. And I think building on the previous panel discussion, how do you make it real? And when is the right time to do it? And that's where In Residence comes in for us. In Residence really is a structured model for JPMorgan and early stage companies to genuinely co-create value. So what does that actually mean? It means, one, we've re-engineered all of our processes in terms of procurement, legal, risk. Many of the tropes and complaints that you hear about from early stage companies working with large corporates, regardless of the industry, you have to redesign all your processes. Two, it's actually getting the right people in the bank to engage with early stage companies. And then the third is making sure you have the right decision makers working with these startups to assess companies and take them from, first meetings, working with them, proof of concept, and then into deployment. And why does this actually matter? And I think from our perspective, I like to call it the fourth way of doing business. Traditionally, if we're trying to solve a client need, we can build product internally, we can partner with established vendors, and we can buy companies and integrate them. And now there needs to be a fourth way of doing business, which is genuinely, when it's right, collaborating with early stage companies to create product. And in order to do that, you need to have different processes, different people, and also align expectations and outcomes. And that's, for us, where the in-residence model fits in. We're taking companies from pitch ready to enterprise ready in a very tailored model, and we're aligning the incentives between, JPMorgan and these early stage companies. So I'll just close on that. Just to summarize, it's why now, it's how do you think about innovation, and then the third is, in residence as a case study to actually deliver tangible value when you want to co-create with startups. Thank you.
Thanks, Ollie. Next, we're going to hear from Andrew Ellis, who's head of strategy and head of innovation, commercial and private banking at RBS. That's a $4 billion business. It includes brands like Quartz. And he is going to talk to us about delivering innovation at an incumbent bank. Andrew, please share.
Thank you, Jason. Good morning, everyone. My name's Andy Ellis, and I'm going to build on what we've heard from Ellie and from Ollie and others in terms of how you practically push through innovation in an incumbent bank. I'll start with a bit of history, though. So many of you will be thinking that RBS and other banks are not particularly innovative. But I had a look in our archives just before I came on here, and I discovered in 1728, we innovated and invented the overdraft. 50 years later, we pushed on and we invented the multicolored banknote. Following on a leading edge, 50 years later, that's 200 years ago, we invented the double-sided banknote. And amazingly, all those innovations endure today. I'm not sure what that tells you, but that's pretty impressive. And I guess what I'm trying to say is that banking's fundamentally the same business as it was back in the day when my forefathers used to bank Adam Smith and take his money and lend it to Bonnie Prince Charlie to fund the Jacobite Rising. So a very standard business over the years. But I'm being a bit tongue-in-cheek, actually, because if you think about more recently, I guess you've had the ATM, you've had contactless cards, you've got mobile banking. So we are moving at pace. But ultimately, commercial and private banking is the same business as it ever was. It's relationship-led. It's selling age-old products based on innovations of 200 to 300 years ago. And also, really importantly, this industry, and my bank particularly, is all about resilience and confidence. It's about security. Back in 2012, we had a systems outage for days, and for weeks if you're in Ulster. Our customers couldn't make payments or get cash. So imagine a tech business that's focused on making sure that never, never happens again. And we spent hundreds of millions of pounds and paid a fine of 50 million pounds to sort that out. So where am I going with this? 18 months ago, I accepted a role in that organization to do innovation in a bank that's 200 or 300 years away from its last big innovation, that was focused on resilience and not experimentation. And actually, I'm really glad that I did. I'm glad that I did because we're making good progress, actually. We're doing some good things. We've got some real things that are live. We've built an in-house capability. At any given time, I've got upwards of 15 projects that are going live. Some of you may have heard of a couple of them that we've gone in the press with. So we've got something called NIFT, which takes an interactive overlay on our terms and conditions. Set up a small company to do that, and that changes dramatically how our customers engage with their contracts. Dramatic difference. We've also got something called ESME, which is a direct lender. We lend up to £150,000 to startups. You can go from a new customer to drawing down your money in 1 hour, and you can do that 24 hours a day, 7 days a week. And also, we've got lots of things, as you would expect, around artificial intelligence and things that respond to the open banking agenda. So lots going on. I'm not saying we've cracked it, far from it, but I think we're making really good progress. And I've distilled down to 5 reasons why I think we've been able to make that progress. Number one, my boss is really senior, and she really means it. Now, that sounds a bit kind of facile, but it's really important. I spend 0% of my time convincing those above me that I need more resources or I need to go more quickly. And I can't tell you how helpful that is, that I can focus on getting things done rather than managing upwards. So, massive point. Secondly, governance, getting that right. Sounds really boring, especially for a fintech audience, but I have my own ring-fenced budget. I'm able to give seed money. It's not based on detailed business cases. It's not based on positive MPVs. It's based on taking a good idea with a customer pain point and getting it going quickly. I also have a business owner for each and every initiative that I kick off. From start to scale, I make sure that I've got a business owner who pulls it through rather than me pushing it to them. Let me give you an example. So I fund lots of small artificial intelligent proof of concepts. Just give them a go, make some bets. They usually come from me, via me. But if you were to talk to our head of data and our head of the business, so for example, covenant testing, they would 100% say that that's their initiative. And that's exactly how I want it. Thirdly, in governance, and this is something that Ollie touched on a little bit, is that we need to keep pushing through the standard bank processes. My team, I constantly remind them to be unreasonable. I constantly tell them to say no and to push against all the icebergs, the machine that's trying to stop us going quickly. Thirdly, is to start small and do a lot with a little. So when I first kicked off my team 18 months ago, people were going, who are these guys? Are they dreamers? Are they lab nerds? Are they here to disrupt my business? Who are they? So I thought, well, rather than explain who we are, let's just do some stuff. So again, going back to my direct lender, we quietly built with a fintech partner from Israel a digital lending platform in less than 12 months for less than £1 million with a core team of about 5 people. When we did that, that created a lot of goodwill for our customers, with our customers, and in the bank, made the business owner look fantastic, created a positive snowball effect, and all of a sudden, people wanted to come and talk to us and collaborate with us. So that was about showing you can do a lot with a little. Fourthly, have a portfolio of initiatives with different risk profiles. What I didn't want to do was kick off a bunch of high-risk projects with a long gestation period, so I'm not sure I would have been around to see the end of them. So I wanted to get runs on the board. And people are often really sniffy about what they call incremental innovation or innovation with a small I. I disagree. I like to do things with proven technology that make marginal improvements to existing propositions, because that gives me credibility, it gives the organization muscle memory on getting things done quickly, and it gives me some air cover as I do the bigger things, the bets that might make a big difference. Now, it is important to do those bets, because that's why we're in it, where it's not a hobby, but I think it's important just to kind of get going, get some momentum on some small stuff. Fifthly, my final point is hire for resilience, not for creativity. You can partner for creativity. Innovating in a corporate, as some of the previous speakers have touched on, is all about organizational savvy. It's about knowing the institution, finding a piece of tech that's got commercial benefit, and landing it. I've got access to all the fintechs I need to. They've got billions of pounds of funding. They've got super smart people thinking about customer problems. I need people that can join the dots and get something changed in an organization. To give you a small example of that, we got a bunch of customers in to co-create back in February on cyber risk. The outcome was extremely simple, which effectively said that within RBS, because we're a big organization, we've created a good e-fishing capability. Many SMEs can't afford to do that. So what we decided to do was give SMEs access to our e-fishing capability. Very, very, very simple proposition. But what that does is it gradually changes the eyes of our customers with how they see the bank. And that's all about joining dots, not taking fancy technology. So, in summary, 5 things that I think we've done well so far that have enabled us to progress. 1, super senior boss who really, really means it. 2, get the governance right. 3, start small. 4, get a portfolio of initiatives with different risk profiles. And 5thly, don't hire for creativity, hire for resilience and delivery. Before I kind of finish and hand off, I just want to say, fess up, it's not all plain sailing. There are a few things that I have to manage day to day. Partnering with fintechs is crucial. It's the thing, but it's really, really hard. It's time consuming and it's massively unpredictable. So don't think that's an easy thing. Secondly, don't be fooled by early momentum. MVPs, design-led thinking leads to kind of flashy things up front. Nothing matters until it hits the customer or improves the life of the shareholder. So keep that end in mind always, because the last bit's the hard bit. And then thirdly, failing fast. Easy to say, very hard to do in a large corporate. The longer you continue, the harder it is to kill. People get associated with things. And we're not systematically set up to let anything fail or to be failures in our organization. So a massive cultural issue, I think, for incumbents. So on that point, I'm going to stop there. In summary, it is possible to innovate in a corporate. In fact, it's really fun to innovate in a corporate. My parting words would be get your sponsorship right, get your governance right, hire a few doers, and then get on with it. Don't overthink it. If you do get that right, I think in terms of productivity and pace, it can be quicker and cheaper to change than ever before. And I'm hoping maybe that some of the changes I make will be around for another 300 years, like the overdraft. Who knows? Thank you for listening.
Thanks, Andy. Great, excellent. So those are 2, centuries-old banks perspective there. Next, we'll hear from Ann Boden, who's the CEO of Starling Bank, which is a challenger bank recently founded, and it's ahead of many of the others in terms of having actual current accounts and all that kind of stuff. But she comes from Allied Irish Banks, ABN AMRO, RBS, UBS, Lloyds. She's seen it all of the established firms as well. She's always outspoken, and she's here to talk to us about post-truth banking. Ann, please.
I think I'm going to disagree with some of the previous speakers, and that's probably expected. I was a traditional banker. I spent over 30 years working for some of the institutions I worked for Lloyds Bank, Standard Chartered Bank, UBS in Zurich, ABN AMRO, RBS. In RBS, I ran the transaction banking division over 34 countries. I stepped away from that job and spent a year in FinTech. And I learned a lot in that FinTech year. And I tried to apply some of those techniques when I went into Allied Irish Banks as their chief operating officer. I came to the conclusion that customers had changed, technology has changed, and every other industry had changed. People were shopping differently. They were using Amazon. People were buying their music differently. They were using iTunes. But banking hadn't really changed. The overdraft was still the overdraft. Things hadn't changed since 17-something another. And I decided that I wasn't going to protect the old model. I quit my job to start a new bank. And I decided to start a bank, not a fintech. And I'd like to tell you what I think is going to happen to the banking industry in the coming years. The big banks have owned the whole value chain forever. A bank sets out to sell you one product and then upsell and cross-sell other products, and sometimes mis-sells as a natural consequence of upselling. And these organizations capture a customer and then try and deliver more and more products to that one customer group. Customers are far more intelligent than that. They have choice in all other parts of their lives. They deserve the best product from the best provider. So Starling Bank is very different. And at this point, if you're all those people who live their lives on the mobile, you're probably fiddling with your mobile now, okay? So go to the App Store and download Starling Bank. And you should, on your seats, you should have a little fortune cookie, break it open, and you have a code inside, okay? So you too can experience new style banking. But our product, our customer experience is very, very different. Yes, Andrew, open your cookie. Go on, try it. Okay. So our experience is very, very different. We have a current account with a debit card and direct access to faster payments. You conduct all your business on the mobile. And because it's on the mobile, we can actually collect lots and lots of information about your day-to-day financial life. But what's different is that data is your data. It's not the bank's data to sell to you other products. It's your data. It's all about making sure that you have the data about your financial life to help you make the right decisions. And what we do, we collect all the data around your transactions, and we use machine learning and artificial intelligence to create insight to help you, the consumer, the one that really matters in the relationship, help you make better financial decisions. And then we allow you to share that data with people that you want to share your data with using open APIs in a marketplace of products. So what's very different about us is we believe you have the right as consumers to buy the right products from the right providers. You have the right to get your information collected in the way that you want it and use it to your advantage. Starling Bank works on the basis of creating this infrastructure where we play nicely with other partners in a marketplace. We've heard here today how difficult it is for fintechs, new entrants, startups to actually cooperate with big banks. We at Starling know that the world is going to look very different. It's all about an ecosystem of people playing together nicely, where they support each other to give products to customers. So today, for startups in the audience that want to actually use banking APIs, you can simply go to our API site, and there's a developer portal, and everything you need there to start using the Starling APIs and using real bank accounts. You, startups, can start building your businesses on Starling's infrastructure today. We are very, very easy to engage with, and that's the idea. So Starling Bank, we're a startup, we're a fintech, we're a real bank in that all our customers' deposits are protected by the Financial Services Guarantee Scheme, but we're also a marketplace and a platform. The question I always get asked is, what is the new business model going to look like? Are the RBSs, the Lloyds, the JPMorgans going to exist into the future? Yes, some of them will. Many of the existing banks are taking the challenge very, very seriously. At the top levels in RBS, there are detailed conversations about digital engagement being relevant to customers. The problem is that whilst these big banks can copy all the products being created by the fintechs, The challenge is going to be slimming down their organizations fast enough to compete in this marketplace. At the moment, we have three sorts of entities in fintechs. We have the big banks that are putting a lot of money into understanding what fintech means, engaging with fintechs. You can basically dine out any evening of the week in London in a fintech event sponsored by a bank. Then you get prepaids and the new consumer-focused organizations that are creating very, very interesting business models. But the revenue stream is not predictable. What they are doing is raising customer expectations and lowering price. In the long term, those propositions are unlikely to be profitable. And then you have people like ourselves. We have people like ourselves believing that the world has to be open, that banks should provide the infrastructure, the connectivity, the protection to consumers. And we can coexist in an ecosystem of other products from other people and organizations and startups, big and small, that address specific areas of the value chain. Because if you focus on what we do very well, we'll be very successful. If we try to do everything for all segments, to all customer groups, through all channels, will just be a little RBS with less scale and just as little innovation. So, my view of the future is, with open APIs, a marketplace, an ecosystem, we will change the value chain of banking. Because with PSD2, all banks have to become open. And the challenge to us all is, in this new world, will the banks become invisible? Under PSD2, the account could be provided by HSBC and the app could be provided by RBS. Or could the app be provided by Google or Facebook? The banking industry has to sit up and take notice, because unless we create a new business model where we each play our position to their best advantage, we could have a world where the rails are provided by the banking incumbents and the front end by social media companies that understand the customer relationship. And if we take it to the logical conclusion, we could get invisible banking. That since the 1700s, we've had banking that's looked roughly the same. It started off by going in a branch and filling in a ledger. The ledger became the call center. The call center became the web. The web became the app. We haven't really transformed. The next thing could be that transactions disappear altogether. You walk into a shop, you take the goods you want, you walk out the door, and you have a great feeling you spent enough money, or you actually feel the transaction in your bank account. Things could dramatically change. And wouldn't that be good? Because I think consumers need a better deal, and they want to see the change they've seen in every other part of their life from their banking relationship. Thank you very much.
Thank you, Anne. Safely. Please come up, guys. Excellent. Well, a wide variety of experiences and ideas about the future of finance there, which should make for a lively discussion, I hope. First, I want to put some of that...
Split us up.
Put some of that to Andy and Ollie, in a sense, starting from scratch, and you're starting from being open, and you were talking about this new ecosystem where the banks are invisible in some sense. I mean, Ollie and Andy, you're both, running. You're talking about the portfolio approach. You have seed money. You can plan all this kind of stuff. Do you share that view for the end game of that, or I mean, you're both at big universal banks that do try to do everything for everyone. And Anne's talking about a much more kind of federated
Yeah.
model. I mean, how do you think about that going forward?
Yeah, actually, I think lots of Anne's points actually resonated with me. I think there's a saying, there's only two ways to make money, bundling and unbundling. And actually, we're just coming at it from two different perspectives. And I think both models may prove viable in the end. However, I do feel, and I think there's a definition point here, on the wholesale banking and capital markets perspective, the ecosystem vision that Anne laid out is actually something that we're already working on. And I think in a very similar way to Anne's vision, at JPMorgan, we're looking at bank as a platform, having, in a similar way, our own developer platform, the rails, the infrastructure. And I think the strengths we have is the scale, the capital, and the existing client base. And then through programs like In Residence, the opportunity to partner with new entrants to deliver services to clients. So I actually believe in the vision. I just feel we're coming at it from two different angles, and the game is wide open as it is.
Yeah. What do you reckon, Anne?
No, I completely agree with that, Anne and Ollie, actually. And I think Anne characterized the competition very well, which is very different than it was a few years ago. But I think if you sat us all in a room and asked us to explain our vision of the future from a consumer-led connected banking perspective, it wouldn't be too different. The question is who's going to win and who's going to get there quickest. And Anne characterized the benefits and the pros and cons of each side very well.
Right. So I'm kind of curious also, talking about the portfolio approach at the big established companies, and talking about failing fast and that kind of thing. I mean, banks like RBS, JPMorgan, big established companies, I think maybe failure is not as embraced as it would be at a startup, at a fintech, that kind of thing. I mean, how do you sell that upwards? That I'm making these bets, I'm planting these seeds, I'm bringing these people in. And if you think like a VC, a lot of them are going to blow up. I mean, how do you sell that at like a staid organization that doesn't really embrace volatility like that?
I'm very sympathetic to the
Okay.
RBSs of the world and the incumbent banks. I was there, I know how difficult
Sure.
it is. And I think that if you think of the total spend on technology and change, we're talking about £1 billion plus, okay? So if somebody's talking about putting 5-10 million into it, or 20 million, that's peanuts. So people are very, very prepared to put relatively small sums of money for the traditional bank, big sums of money for fintech into projects that create innovation. The question is, and I've been there myself, I've been the CIO of big incumbent banks. You're not going to embark upon a project to migrate your whole customer base of millions and millions of customers onto new software provided by a fintech that's only been around for 2 years. You're just not going to do it. The risk is too high. So although at the top level of organizations, at the big banks, people are taking this very, very seriously, and I have a lot of empathy with them. The problem is they are dealing with a huge problem. They have to worry about availability and service delivery to tens of millions of people. When you're a smaller organization, you can take more risk. And I think that if I was a CIO of a big bank, I'd have huge difficulty deciding to press the button on a conversion between old software and new software. Career risk, customer risk, it's too big a risk to take, and therefore you find that selling these small fintech software companies into big organizations is very difficult for very, very good reasons. It's not just because the big banks are being difficult or don't appreciate the culture, it's because it's a difficult problem to solve.
Right. Yeah.
Jason, to answer your original question, how do we fail fast in a portfolio effect? I think that my two key levers, and I admit we haven't cracked this completely, is that we tend to run off in design-led sprints. So at the end of a 10-week sprint, it's much easier to stop something than it is later on. And then secondly, we try and structure as if we are investors. So we follow a seed, Series A, Series B type funding, as opposed to saying, look, you're going to build something classically. Here's a check for tens of millions of pounds. Tell us when it's red, amber, green. It's about prove yourself with a small amount, a bigger amount of even bigger amounts, and when we tend to give similar amounts as you would if you were getting investment. So that's another lever that we try and bring that kind of vitality in.
Okay.
I think
JP?
just responding to Anne's point, I actually feel I'd actually disagree with some of those points. I think we traditionally CIOs are incentivized to buy services from a selected number of technology partners, mostly because they had to do everything on-prem. Now, especially with the emergence of like the public cloud providers, and I'd use WhatsApp as an example when it was acquired by Facebook. WhatsApp was servicing billions of customers across the globe with a handful of employees. So at least from our perspective, and this is something we're doing today, is one, you have to innovate from the core, and you have to do things at scale. And two, I think going back to the fourth way of doing business, we're doing this today with early stage companies and moving them into production, servicing like thousands of customers and moving money at scale. And I think the difference is, especially enabled by cloud, is you can now put fintechs or early stage companies into production, whereas historically you couldn't do that, mainly because of the public cloud limitations. So I think that's one difference where actually I would say you can actually collaborate with early stage companies to actually do things at scale. I think, yeah, go for it.
Sorry. I just follow up on that. That gets to kind of the end game of this, which I'm interested to hear from everyone on the panel, which is, I mentioned at the outset, I was looking at the stats, the participation of corporate venturing in fintech deal making is a straight line up, basically. What do fintechs get from a corporate venture partner, from partnering with the likes of JPMorgan or RBS or another established brand, that they wouldn't from a VC or some other way? Because there's always this idea, like, are they hoping to get hired? Are they hoping to get acquired? Are they, does the scale of a big bank and customer base help them do something else? Or once you partner up with a big bank, are you always, is the end game you're always going to get swallowed up by it, and that's the kind of goal?
Sure, yeah. So I think just taking corporate venture as a topic, and I think, and from obviously a corporate lens, like, you have to be careful, like, in terms of why you're setting up your fund, and you have to have very clear goals. And I think there's two main approaches. One is having, setting up a corporate VC. There's a dedicated pool of capital. It's ring-fenced from core company, and that services a variety of needs, mainly as a hedge to the existing business models and to generate IRR primarily. For those types of businesses, as a fintech, you have to think through, like, what am I actually getting from these investors in a similar way to any VC. The way we do it at JPMorgan is we do everything on a strategic basis. So we don't have a dedicated pool of capital. If we do invest in companies, it's complementary to the work we're doing with them as partners. And the reason we do that is it's to help align incentives. It's ensuring that we're one team, one dream, genuinely. And IRR is not the primary reason. It's actually to ensure that we're aligned together. From the startup's perspective, you have to answer exactly the same questions, and we try and be genuinely honest in terms of defining success up front. Why are we actually doing this? Are we the right partner? Is this right for the startup? And some of the advice we give to startups that we're working with is making sure that they're getting the right funding from the right people and have very clear and honest conversations.
Yeah.
But that assumes that the relationship is equal, okay? For many startups here today that's looking for their seed round or their A series, whatever, it's tough. They can't pick and choose. And if a big bank venture fund comes along, it isn't an equal relationship. And in some respects, you have the big bank can pick and choose. The startups can't. And the question is, although you talk about giving advice to startups, in practice it's very, very different. You've got lots of big banks sponsoring sort of incubators, You've got lots of those incubating companies who come to the end, win all the prizes, and at the end of it, sort of expect to sell their product into a big bank. And all of a sudden, it doesn't happen. There's a huge number of companies that are actually let down in that relationship.
I guess just from an RBS perspective,
You do have ring-fence capital, right? Is that what I...
No, absolutely not. So we do not have ring-fence capital. We thought about it, and we decided when we're not a private equity company, we decided that we weren't best placed to pick winners, that we'd have to have, not just for Christmas, as it were. So we deal very much on a commercial relationship, and I find that I get the access I need to the fintech community and the product I need that I can bring in and the influence on that company without taking stakes in them. So that's just the route that we've gone down.
Okay.
I have ring-fence money to invest within the bank and do commercial. I don't have equity stake.
I just agree entirely with Anne's comments. I think that there's a lot of noise, there's a lot of hype. Early stage companies, are not always aware of the resources out there, and I do feel that, from our perspective, we're just trying to be very honest in terms of what we're actually good at and what services we can provide, and that's where In Residence comes in as a gap, which is taking you from pitch ready to enterprise ready if it's actually suitable, and setting those clear expectations. Otherwise, it's a waste of our time, it's a waste of the startup's time, we're not generating any value for anyone.
Right.
And my advice is to get to market, if you're a small startup and you want to actually develop your business, you can't actually wait 6 months, 2 years for a big organization to make decisions. Try to find some way of getting your product to market today. Go out there, attend hackathons, build stuff, try and find some APIs you work with, try to enter some of the competitions, engage, get something out there. Don't have endless meetings with big banks. They're going to take 2 years to decide. It is so soul-destroying for these companies.
Well, the good news is I tell my team to limit how many big meetings, how many coffees they have. So we're aligned in that regard.
Yeah.
And what's the current state of your collaborations with big established banks and other players? Are there any, or are you strictly disrupting?
Okay, we're a bank, okay?
Sure.
We didn't decide to start a fintech without a banking license. We're a fully licensed bank that has access into MasterCard issuers, we're access to faster payments, whatever. We provide services to other people that want other fintechs, so other fintechs use our payment rails into faster payments. We also have a marketplace where if somebody's developing a product, they don't have to go through a 6 months debate with a big bank about using it in a very difficult contractual way. They can basically get onto our website today and start using our APIs, and they can have a product up and running by the end of the week. In fact, I was at another conference. I'm not going to mention competitor conferences, but there was another track in another room. And I was told on the way out that somebody had been demoing a product they'd built on Starling Bank's platform. And this was a voice recognition system. And they were a company called Houndify. And they had developed an application where you asked Houndify if you could afford the next BMW. And that company sent information using our APIs and asked the bank account in the background. So that is where a startup that had very, very little contact with Starling had got a product to market very, very quickly. And it didn't involve lots of conversation and lots of debates and lots of contracts. We're providing a SaaS service to startups that want to get into banking.
Okay. Interesting. So to talk about, we have just a few minutes left, to talk about the actual business of fintech, let's say. I'm curious to hear from each of you about the state of the art in fintech. What's overrated? What's underrated? What is perhaps properly rated? We mentioning things like AI, machine learning, chatbots, blockchain. This is everyone. There's a bunch of booths out there pitching all this kind of stuff. What are you most excited about because it has more scope? What are you maybe a bit cool on because it's not necessarily as promising? Let's start with
First of all, blockchain. I think blockchain is first going to be implemented in more complex businesses such as trade finance and those sort of things. We're not using blockchain at present. We are into AI and machine learning. We think that your current account data is such a rich source of lots of information about people's day-to-day lives, and using that data to give insight to people to help their own financial life and see their money in a new way is absolutely fantastic. So that's what we put in our sort of our eggs in that particular basket. We think that's going to have great breakthroughs. As far as chatbots, people build chatbots all the time. The question is, I think we're seeing lots of things that look good. Are they really changing the face of financial services forever? Not so. I'm betting on AI.
What's next? What are you most excited about AI? Can you tell us a bit about what we could do a year from now that we can't do now?
We've got huge sources of data from people's interactions all the time. Where they are, what they're doing, what they're spending their money on, how they feel about those purchases, and images around those purchases. Using that to give insight, to protect people's money from fraud, to actually give them a feeling of whether they're going to have enough money to the end of the week, the end of the month, the end of their life, could make people's financial lives better. And to be honest, the most important thing to people is their health, their family's health, and then their financial health. So we're using AI to solve a big problem, and I think that's important.
Okay, great. Andy, what's
unfortunately, I find myself agreeing with Anne, which is really disconcerting. So I agree. Look, data, especially in a big bank, we got loads of it. We need to do a better job of being predictive and learning how our customers will behave. So I think AI data is a massive one. I think who knows how it's going to play out. I like to make small bets and kind of see what flows. I agree on chatbots, even though personally I quite like chatbots and voice and avatars and stuff, because I think it brings it alive. It's engaging, so it's a small way of doing some interesting stuff, but it's a channel. It won't change the world. But increasingly, I don't think of innovation through a tech lens. I think it through a customer and a proposition lens. So in open banking, what APIs, what can I stitch together that makes the world a better place for customers? So I rarely think I need to use some tech. And then blockchain, I'll leave that to Ollie, because I kind of agree it's probably more his space. But we do some stuff in there.
How excited and or wary as a big bank like RBS with millions of customers, how are you worried about the implications of open banking and PSD2 and all this kind of stuff?
I'm not worried about it. It's my job to respond and get on the front foot, so it gets me up every morning. So I'm quite excited about it. Yeah. I guess one thing I would say about things like building on AI and what have you is once the regulators look at it, and then you start to get really quite complicated and say, what's the outcome, what's the certainty of outcome that this machine learning is providing? It becomes a lot harder to explain than a straight line through. So I think there'll be some interesting regulatory maybe constraints around the use of machine learning.
Great. Ollie, what's...
just to finish off, what am I most excited about? I think given the capital markets and wholesale banking lens, blockchain is always a topic. Just to make it real, what are we actually doing? And going back to that portfolio approach is, one, we have a team of engineers. We've set up our own dedicated capability of great people building products within the firm. Two, we've invested in a few companies, two of which are public, Digital Asset Holdings and Axoni. And again, similar, doing a lot of work in the trade finance space, wholesale payments, on settlements and clearing, and some really interesting work going there. I think the third thing is actually the development of Quorum, which is the protocol we've developed, a fork of Ethereum, which we've now open sourced into the Enterprise Ethereum Alliance. So I think for us, and I think that's a clear example of Anne's hypothesis earlier, is about open sourcing, open banking, and actually for us we're super excited about Quorum and getting fintechs on Quorum developing using technology that we've open sourced. Okay. That's one. What do I care less about? You mentioned chat. I think for me, and it's all about the customer and the way customers want to interact with us, and whether it's chat or voice, which is increasingly coming up now. For us, it's just thinking through what does the customer want? How can we create delightful product to satisfy our customers? And what's the right way to deliver it? And whether it's chat, voice, email, I think for us we have to be wherever the clients are.
Yeah, great. Well, we're out of time, and so I would just sum up there by, if you have chat bot or other messaging app, you're going to have to hone your pitch, really make it really strong. It might be tougher. AI, blockchain, that kind of stuff seems to be living up to its promise. But also, we also heard a lot of different approaches about collaboration and cooperation and competition, and about how all that is good between the big firms and the startups and the challenger banks and everywhere in between. So all that's left for me is to thank Anne, Andy, and Ollie for sharing their insights with us. Thank you very much, guys.
Thanks.
Welcome.